Good afternoon. While you were scrolling through your feed today, something happened that most people won't notice until it's too late. Between January 12th and January 19th, just 7 days, 33.4 million ounces of physical silver vanished from the COMEX registered inventory. That's 26% of what was supposed to be sitting in those vaults. Gone. I've been trading commodities for over a decade, and I started this channel because I was tired of watching AI-generated garbage flood the silver space with recycled talking points and zero actual data. So let me be clear about what I'm bringing you. I have access to Bloomberg terminals, vault reports, and institutional-grade resources that let me see these moves 12 to 24 hours before CNBC even thinks about mentioning them. And what I'm seeing right now is not a typical rally. It's Wednesday, January 21st, 26. The spot price hit $95.89 earlier this morning. The financial media wants you to believe this is retail FOMO mixed with Greenland tariff hysteria. They're calling it a speculative bubble that'll collapse the moment some trade deal gets signed. But here's what they're not telling you. The real story is not the number on your screen. The real story is the drain. While everyone watches the ticker climb, the actual physical bars are being locked away in private vaults. The paper exchanges are holding nothing but promises, and those promises are starting to look very, very empty. So here's what we're doing in this video. I'm going to walk you through the mechanism that's breaking the global paper silver system. I'm going to explain deep backwardation in a way that actually makes sense. I'm going to run the math on the 200 million ounce deficit everyone's whispering about. And at the end, I'm going to share my personal battle plan for when silver crosses $100. Because it's not a question of if anymore, it's when. Let me start with where we are right this second. I was looking at the markets a few hours ago, and here's the snapshot. Spot silver is sitting at $95.01. Intraday high was $95.89. The gold to silver ratio has collapsed to 50.5 to 1. Just to put that in perspective, we were at 100 to 1 last year. That ratio has been cut in half. The dollar index is at 99.08. The dollar is weakening, but silver is rising even faster when you price it in euros, yen, or yuan. This isn't just a dollar story, this is global. And here's the kicker. On your screen, silver is just a digital number that goes up and down. But in the real world, China implemented new export licensing on January 1st that has effectively choked off 10% of global supply. This isn't speculation, this is policy. And the market is only starting to price it in now. Let's talk about that inventory number again, because it's not being framed correctly. 33.45 million ounces withdrawn in 1 week. That is not trading activity. That is a run on the bank. When you see that kind of physical movement, it means someone, or multiple someones, decided they don't trust the system to deliver later, so they're taking possession now. Think about what that means. These aren't retail stackers buying 10-ounce bars from their local coin shop. This is institutional size. This is the kind of withdrawal that happens when major players lose confidence in the paper market's ability to settle in metal. Now, I know a lot of you have heard the term backwardation thrown around, and it gets used incorrectly all the time. So let's pull this apart, because understanding this mechanism is the key to understanding why the big banks are trapped right now. Normal markets work like this. The price for future delivery is slightly higher than the price for immediate delivery. That's called contango. It makes sense, right? If I'm going to store something for you for 6 months, I'm charging you for that storage and for the time value of money. That's how commodity futures are supposed to work. Backwardation is when that flips. It's when the price for immediate delivery is higher than the price for delivery 3 months or 6 months from now. And when backwardation gets extreme, when we call it deep backwardation, it's a signal that the market has lost all trust in future supply. Here's the analogy I use. Imagine you walk into a crowded restaurant, and you notice people are paying $100 to eat a burger right now instead of $50 to make a reservation for the same burger 3 months from now. Why would anyone do that? Because they know the kitchen is out of meat, and they know those reservations might never get honored. That's what's happening in the silver market right now. The spot price is screaming higher than the forward price because the people who actually need physical metal don't believe it is going to be there in 3 months. They're paying the premium to get it today. Now here's where it gets brutal for the bullion banks. These institutions have sold massive amounts of silver they don't actually have. They've been operating on the assumption that they can always roll their positions forward, kick the can down the road, because in a normal market, contango lets them do that profitably. But in backwardations, that strategy becomes a death sentence. Every time they try to roll a short position forward, they're losing money. And if the backwardation deepens, those losses accelerate. They're trapped in the kitchen with no burgers left to flip, and the customers are getting angrier by the day. This is not theoretical. This is happening right now. And the reason you're not hearing about it on CNBC is because the people who are trapped are the same people who advertise on CNBC. Let me walk you through the math, because this is where it stops being a story and starts being a structural problem that cannot be papered over. On the demand side, industrial consumption for 2026 was projected at roughly 550 million ounces before this rally started. Solar alone accounts for about 160 million of that. Electric vehicles, electronics, medical devices, the list goes on. Silver is not optional in these applications. There is no substitute that works at scale. On the supply side, global mine production is around 830 million ounces annually. Recycling adds another 170 million. That gives us right around 1 billion ounces of total supply. So at first glance, it looks like we have a surplus, right? 1 billion in supply versus 550 million in industrial demand. But here's what that number is missing: investment demand. When you add in the physical bullion purchases, the ETF inflows, and the sovereign buying programs that we're seeing from central banks in Asia and the Middle East, that surplus evaporates. We're running a deficit of at least 180 million ounces for 2026, and that's the conservative scenario. Now let's stress test this. If the rumors about force majeure on the March COMEX contracts are even halfway true, and I'm hearing this from multiple sources now, then we're looking at a situation where even 5% of paper contract holders demanding physical delivery could trigger a gap up to $150 or higher. Not because of speculation, because the metal literally does not exist at the current price. The paper to physical ratio hit 350 to 1 recently. Let me say that again. For every 1 ounce of actual silver sitting in a vault, there are 350 claims on that same ounce. That's not a market. That's a Ponzi scheme. And the math says it's insolvent. Now, I want to address the skeptics, because there's a legitimate argument being made right now that I think deserves a serious response. The substitution cliff argument goes like this. At $95 an ounce, companies like LONGi Solar will pivot to copper paste solar cells, and that will destroy industrial demand for silver overnight. The price will collapse because the primary use case evaporates. Here's my rebuttal. Industrial pivots take years, not weeks. I've looked at the engineering reports. I've talked to people in the supply chain. Copper-based photovoltaic cells are failing oxidation tests in the field. They degrade faster. They're less efficient. Yes, they're cheaper in terms of raw material cost, but when you factor in the lifespan and performance loss, the total cost of ownership is higher. Can companies eventually engineer around this? Maybe. But we're talking about a multi-year R&D cycle, followed by retooling factories, followed by getting new products certified and deployed at scale. That doesn't happen in 2026. It doesn't happen in 2027. This is a 2029 or 2030 story at the earliest. And here's the other thing. Even if substitution does eventually eat into industrial demand, we're still in a deficit because of the investment side. Sovereign wealth funds and central banks are treating silver as a strategic asset now, not just a commodity. That behavior doesn't reverse because solar companies find a cheaper paste. There's another myth I need to bust while we're here. Silver follows gold. You've heard that 1,000 times, right? And when gold goes up, silver tags along because it's the poor man's gold or whatever. That's not what's happening in 2026. Silver is not following gold. Silver is following scarcity. Gold is a luxury. It's a store of value. It's beautiful. It's inert. It's historical. But it's not mission critical for the energy transition or the AI build-out or the electric vehicle supply chain. Silver is. Gold is optional. Silver is necessary. That's the regime change we're witnessing. Silver is being reclassified from an industrial byproduct into a Tier 1 national strategic asset. And once that reclassification is complete in the minds of institutions and governments, the price discovery mechanism changes permanently. So let me recap where we are before I walk you through what happens next. We have a physical inventory drain that is accelerating, not slowing down. We have a China export ban that took 10% of global supply off the table. We have a futures curve that is deeply inverted, signaling that the market does not trust future delivery. And we have a paper to physical ratio that is mathematically insolvent. The paper shorts are cornered. They know it. The only question is how this unwinds. Here's what I'm watching for next. The institutional reaction is going to be margin hikes. The CME has already raised margins twice this month. I expect them to do it again, possibly pushing required margin to 30 or even 40%. Why? To force small speculators out of the market and protect the big shorts. They'll frame it as maintaining market stability, but what they're really doing is trying to shake out the retail players so the banks have room to maneuver. The other thing I'm watching is lease rates. If you don't know what those are, lease rates are what it costs to borrow physical silver. Right now, they're elevated, but they're not catastrophic yet. If lease rates climb toward 8 or 10%, that tells you the banks are desperate. It means they're willing to pay almost any cost to borrow metal just to keep their positions alive. That's the dashboard metric that will tell you when the system is on the edge of breaking. Now, stop for a second. And look at the gold to silver ratio chart. I mean, really look at it. We're at 50.5 to 1 right now. Historically, that ratio has gone as low as 15 to 1 during previous silver manias. But here's what's important. When this ratio breaks below 45 to 1, the narrative changes completely. At that point, the industrial commodity label falls away, and the monetary panic begins. Silver stops being traded like copper or aluminum and starts being traded like gold. And when that psychological shift happens, the volatility gets exponential. That's the pattern interrupt I'm watching for. 45 to 1 on the gold to silver ratio is the line in the sand. Now let me walk you through my personal battle plan because I know that's what a lot of you are here for. I'm not giving advice. I'm telling you what I'm doing with my own capital, and you can take from that whatever you find useful. Trigger A. If silver holds above $100 for 3 straight days, I am personally trimming 10% of my position. Not because I think the bull market is over. I don't. But the RSI is overbought. The rally has been parabolic, and I want to bank some house money. I've been in this trade for long enough that taking some chips off the table at a major psychological level just makes sense to me from a risk management perspective. I'm not selling because I'm bearish. I'm selling because I'm disciplined. And if you've been in this market for more than a few cycles, you know that discipline is what keeps you alive when things get volatile. Trigger B. If the gold to silver ratio drops below 45 to 1, I am looking to reallocate some of my gold holdings into silver miners. Not the metal itself. I already have plenty of physical, but the mining equities. Because when the ratio breaks that level, the catch-up trade goes into its final, most violent stage. The miners offer leveraged exposure to the metal, and historically they outperform during that kind of move. I'm specifically looking at primary silver producers with low all-in sustaining costs and clean balance sheets. I'm not interested in explorers or development stage companies right now. I want production, cash flow, and the ability to print money at these elevated silver prices. Now here's the other scenario. If the Shanghai Gold Exchange hikes margins to 25% and we see a $15 flash crash, I'm doing absolutely nothing. I'm going to sit on my hands and wait because I know what happens next. The physical demand will floor the price. The dip will get bought. And the people who panic sold into that volatility will be the ones watching the next leg up from the sidelines. I've seen this movie before. The margin-induced shakeouts are brutal, but they're temporary. The underlying physical deficit is not temporary. It's structural. So my plan in that scenario is simple. Do nothing. Let the weak hands get flushed out. Let the price come back. And stay positioned for the bigger move. That's the sit on your hands moment, and it is one of the hardest trades to execute because your brain is screaming at you to do something. But sometimes the best trade is no trade. Let me also say this. I am not using leverage on this position. I know there are people out there trading silver futures or options, trying to maximize their upside. That's fine if you know what you're doing and you have the risk tolerance for it. But I'm holding physical metal and unlevered equity positions. I sleep better that way. And in a market where forced liquidations and margin calls are becoming a real risk, I'd rather own the asset outright than owe someone money on a position that moves against me. This is a long-term structural shift, not a short-term trade. I'm positioning accordingly. Now, before I wrap this up, I want to zoom out for a second because I think it's important to understand the bigger picture of what's happening here. This is not just about silver. This is about the breakdown of trust in paper markets. It's about the financialization of commodities running headfirst into physical reality. For decades, the futures markets have been able to set prices with relatively small amounts of physical metal changing hands. The tail wagged the dog and everyone accepted it because it was liquid and it was convenient. But when you have a structural deficit, when demand exceeds supply and inventories are draining, the paper market loses its authority. Physical starts to trade at a premium to paper. Backwardation becomes persistent instead of temporary. And eventually, the people holding paper contracts realize they're holding nothing but promises that can't be kept. That's the end game for any commodity market that gets over-financialized. And silver is the canary in the coal mine because it sits at the intersection of monetary demand and industrial necessity. It's small enough that a few motivated buyers can move the market, but critical enough that it can't just be substituted away. That's the end game for any commodity market that gets over-financialized. And silver is the canary in the coal mine because it sits at the intersection of monetary demand and industrial necessity. It's small enough that a few motivated buyers can move the market, but critical enough that it can't just be substituted away. We're watching a system break in real time, and the people who understand what is happening have a window to position themselves before the broader market catches on. So here's the recap. We are in a physical run. The futures curve is broken, the inventory vaults are being drained, and the strategic reclassification of silver as a Tier 1 national asset has changed the rules of the game forever. The screen is lying to you about the price. The spot price you see is a fiction maintained by paper contracts and algorithmic trading, but the inventory vaults don't lie. The metal is leaving, and the era of cheap silver is dead. What happens next depends on how fast the institutions adapt, and how much physical demand continues to pressure the system. But the trajectory is clear. We're not going back to $60 silver. We're probably not going back to $80 silver. The floor has moved, and it's going to keep moving higher as long as the deficit persists. Now, if you want to understand the full picture of why this is happening right now, you need to look at the Greenland tariff situation and the Critical Mineral Executive Order that just got signed. Those policies are directly connected to what we're seeing in the silver market. And I did a deep dive on that in my last video. Go watch that if you haven't already, because the geopolitical context is going to determine how aggressive this rally gets over the next 6 months. I'll be back with another update as soon as I see something that warrants it. In the meantime, stay sharp, stay disciplined, and don't let the volatility shake you out of a position you believe in. Good luck out there.